Hello, everyone. Welcome to our webcast, how our companies are navigating world dynamics, a post-earnings review. We have a ton of current investors on the webcast today, and again, hope to see you guys soon. Thank you guys for all of the trust as we navigate many of the dynamics around the globe. There's also a nice amount of other firms that are here, so it's nice to see you guys. Our goal always is to expose our research, collaborate. It does make us better. Also, I see a handful of potential investors. Again, nice to see you as well. So I am Sean Emery, Chief Investment Officer at Avery & Company, a firm focused on investing with conviction across multiple strategies. We want to ultimately own businesses that are either help shaping the future, what we call structural growth stories, or companies that are reshaping themselves to best align with the future. And that's ultimately transformation stories. Our focus, as always, is to grow assets in a disciplined way, knowing what we own and why. That is what keeps us calm and confident during these environments. So you'll see some of that today and why we feel that way. If you are a student of history, then you know that it's easy to see that this is one of the best ways to compound returns over time. And we know that it doesn't come in straight lines. It does require a healthy balance of financial acumen, but most importantly, it does require a balance of psychological discipline. Now, today, I want to be concise enough for us not to bore you, but robust enough to let you see exactly what we see. So the agenda is as follows. I'll first outline the global challenges, what they are, how we're thinking about them. Then I will jump into the companies themselves. Lucky for us, we only have about a dozen. From a disclaimer perspective, this webcast is for informational purposes only. It's not a recommendation to purchase or sell any securities mentioned. And please see the written disclosure page on the webcast. Also contact Houston Hess if you have any questions at all. So let me turn to the presentation. All right, let's start and lay the foundation of the issues at hand, what these companies are ultimately navigating. So we'll go through them rather swiftly, but focus on where we are, or kind of where we are coming from as a globe, and where the data suggests we are going into the future. So here's a flywheel. Here we outline the main challenges. There's a laundry list of issues out there. What's happening is they're compounding on each other, and that ultimately leads to compounding fear on itself as well. So number one is the supply chain. Most of the issues stem from a supply chain that is fixed in terms of its infrastructure. The kind of only able to move goods using physical objects to transport goods, obviously from A to Z. If prices rise at the point of transport, well, that ultimately means that you either don't ship your goods to buyers or you raise your price to offset that. And that's ultimately economics 101. Now, the second one is volatile demand. This is kind of one of the issues that affects supply chains. Generally, what a company will do is they'll look at forecasting models. They'll look at the demand that has been a fairly reliable signal over the past several years and measure past behavior to try to measure the future for themselves. But we know it's a different environment, right? Stimulus created certain behavior patterns that just simply aren't repeating or changing drastically, i.e. volatile demand. And we'll have more on that in a second. The third is inflation dynamics. This has led to inflation rising across multiple categories. We saw inflation begin rising in categories like physical goods, where the supply-demand imbalance was most pronounced. That began to cool off, and we believe that will continue to moderate as the year progresses. And again, more on that in a couple slides. We then recently saw non-physical inflation or service inflation pick up as certain kind of reopening activities continue to emerge. Fast forwarding to number 4, you add on kind of the invasion, which has led to not only fears like nuclear attacks and world wars, but also certain commodities were sent higher, which ultimately amplifies the state of inflation. It goes to number 5, which is another compounding factor, which is Fed rate hike cycle and the uncertainty around it, right? So this has led to 2 roads, like how fast and how aggressive will the Fed raise rates or even pause rates, assuming maybe something happens in the economy. And again, they're not only trying to fend off inflation, but they're trying not to go too aggressive in order to ensure that economic conditions remain strong and fairly stable. So not a sharp recession is ultimately what they're trying to navigate. We have some dynamics or comments around that in a second. Now, when we think about the challenges, ultimately, like what is our approach? And I'll walk through data not only on our companies, but dissect the challenges. But first, I want to, again, highlight our approach. First is we want to own companies that have either kind of strong competitive advantages, so a defensive mechanism during moments of stress. And I think, again, when you look at these three pillars, this is what it's all about. It's finding companies that can sustain themselves, defend themselves during periods of stress, and thrive as they come out of it and as things start to normalize as well. The second part is really around operations. Like, we want strong operations. And ultimately what that means is proven management teams, strong balance sheets, strong margin profiles, attractive margins in general, attractive economics that we think has sustainable characteristics to them. And then lastly, and most importantly for a medium to long-term investors, we want our companies to try to win multiple years out from now, not where the world is, but where it is going. We want to know that companies that sensibly can invest, and we know that companies that sensibly create value for customers ultimately create value for shareholders. And during periods of uncertainty, that value for customers, in our opinion, is more pronounced, which leads to bigger, faster, kind of stronger companies over time. We've seen this cycle repeat over and over again, going back multiple decades. The stronger gets stronger. The strong gets stronger during periods of weakness. So let's start to dig into some data. We'll start with supply chains. Here's the data around the cost of containers that ships goods all around the world. So this is going back to 2018. I think the takeaway is fairly clear. The cost to ship goods, physical goods, soared through 2020 and 2021. Now we are seeing this come down. Over the last 6 months, it is down 20% and down 28% since its peak. It's not hard to figure out why. People got stimulus checks. They bought a ton of physical things. Those things have to be shipped. There is no more stimulus checks as of right now. So that will no longer be a force of demand, which should help assist the supply chain. We talk about volatile demand, which led to, again, different movements in what's going on. So here's inventory to sales. You can see the COVID shock. Ultimately, what inventory to sales is measuring your inventory relative to your sales. So during the COVID shock, inventory, companies stopped buying inventory, sales stopped. But given the fact that, again, sales were much lower than inventory slowdowns, you saw a spike in inventory to sales. That led to, again, companies stop buying inventory. Then right after that, stimulus checks went out and then demand soared. So you ultimately got stuck with an environment where companies were running low inventory balances with strong demand, which, again, is kind of this self-fulfilling mechanism within supply chains and inflation as well. Now, you go to the next page, what we're seeing today, right? So inventories are skyrocketing. Here's a chart going back to 2012. The more inventory, the less price pressures. That's economics 101 again, which, again, this does not show in old inflation readings, but this does help predict what the future can and will look like. On the next page, we look at used car prices. They're hitting a wall. We all know that people had stimulus checks. Rates were low. People were not flying as much and choosing to drive instead. That is demand. On supply. Supply for cars were low. Now, we scan websites such as CarMax and Carvana. The inventory on those sites are above 2019 levels. We think leading to this supply and potential demand mismatch, which ultimately is evident and showing in some cracks in used car prices. So these charts on this page, on the left, this is the year-over-year change in used car prices. You can see it dip negative during peak COVID, only to surge 60%, is now coming down sharply from those highs and back to much more normal levels. We also show the month over month, which has been negative 3 of the last 4 months. So again, there's a lot of weakness in pricing in used cars, which should be a strong reading or metric and input for future inflation. And we already saw that in the last reading, specifically for used cars. On the next page, we're showing car price demand. So we've been using Google search trends as a nice proxy for this. And we showed these charts at the beginning of the year. And ultimately what came from that was used car prices coming down. Ultimately demand, right? It's all about demand. And not long ago, we hit the lows since COVID. So that lack of demand, again, is showing up in the prices that we just showed. This is Google search trends for appliances. You can see the massive spike in 2020. The bottom shows the year-over-year change in search interest. Appliances are heavy items that are shipped and take up a lot of that container space we were just talking about. And the lower demand for this means less demand for containers, at the very least for this. So at least not taking up as much space. And we think at the very least, what you're seeing here is some stability in the demand for appliances. Companies need stability to manage inventory and forecast what they want to do in terms of kind of supply and demand. So when there's instability, specifically as it relates to like inventory and demand, I think it's important. Now let's look at service demand. So here is the search activity for airfares. It collapsed in 2020. You can see that, and it continues to move much higher. Obviously, add on things like the Russian invasion, which sent oil prices moving much higher, specifically a couple months back, which led to the input costs for airplanes, which led to higher prices for airfares. And again, interesting dynamics happening there. This is probably the best page of all this kind of section. We're taking the two together. So the top is year-over-year change in search activity, and for appliances, that's on the top, and the bottom is for airfares. So this is what I mean when I say we kind of, when we name these pages volatile demand, this is like the ultimate volatile demand. Almost to the date, people simply said, we're going on a trip and our appliances are fine. And you saw this whiplash in demand for these kind of product categories. That's why like Target or Walmart over the last several weeks, they saw this sudden change in demand activity. Their inventory that they tried to bring here, if you just recall, is, they're doing it well in advance. When the supply chain has a bottleneck, what these companies were doing was ordering inventory well ahead of time. And if demand signals going back 12 months says this, you can be a little bit more conservative on that. But what we saw was a sudden shift. And that's what you saw on the inventory side. And that's why inventories are rising 24%, specifically in physical categories. I think that's super important thing to watch as demand and supply go the other way. Okay, so that is supply and demand, volatile demand. Crossing off some of those now, what is next is inflation. Here's inflation, both headline, which takes into account everything, and then core, which looks at all of the items less kind of food and energy. Here's several slides on each of those commodities to really show the spikes, and then some of the moves lower or migration lower as some of the pressures felt out there are starting to come down. So on the top here, we have things like grains and corn and soybeans and wheat. And then on the bottom, we have metals, and we also have lumber. Lumber's down 48% year over year. Again, that's an input cost to housing. So you're seeing all those like large spikes happened at the invasion of Ukraine. And those have come down materially across the board. Some of them are still elevated. And then again, you have something like lumber that has come down materially. So that was an important section kind of highlighting the demand across how volatile demand was. And that has led to supply chain issues, which has led to inflation issues. But I think one thing is clear is that the demand for big items is coming down. On top of that, and these two slides here specifically around oil prices, right? And also wheat prices. I'll just quickly show these. So on top of everything we just discussed, again, the Russian invasion amplified inflation. There was inflation already, but it amplified it. Ukraine produces roughly 20% of all high-grade wheat in the world, and wheat rose nearly 90% from January 1st to that peak. But that's come down 37, nearly 40% from that time. And we were seeing some of the rollover in commodities. We can't predict like what is next, but we know that supply will come into balance as higher prices lead to the eventual investment in production. Here's rig counts. I think that's an important one again as well. This rig count to produce, and then we have oil output. They track each other obviously very closely. As prices rise, more production is put into the market, which again ultimately leads to lower prices over time. Now, the last section on challenges is everything I just spoke about, and it makes a challenge for the Fed in terms of what they want to do. And I think the good news is that the market has done much of the work for them. Mortgage rates have already moved higher. Interest rates in other areas have also moved higher. This is obviously leads to less demand, which ultimately leads to less price pressures. Now, is there a recession on the horizon? It's not an easy answer, obviously, but I do think the main question is this: if there is one, will it be shallow, or will it be short-lived, or will it be sharp? Our general view is that, look, it makes sense for the economy not to match last year's growth. Last year's growth had stimulus. Also, year over year, 2021 over 2020 clearly had advantages in terms of some of the slowdowns in 2020. So that plus more stimulus, I think, is this year just simply doesn't have any of that. And so that ultimately means the economy should naturally slow. And we thought that at the beginning of the year in terms of naturally slowing. Obviously, other things happened on top of that. And we do believe, big picture, though, the economy coming much more into a balance is needed. We highlighted the supply and demand and the volatile demand. Look, we need things to not be influenced by external factors like stimulus, so that companies can navigate their supply chains in a very prudent way. Now, that leads us all the way back to our companies. We wanted to share with you that first, and we also want to share what companies are saying, why we remain very confident in their ability to sustain and thrive in this environment. And again, I'm turning to the framework. I think it is important to kind of remind ourselves what we want in a business. We want these characteristics in any environment, but we also think it's important to have them in this environment. Number one, competitively advantaged companies with proven management teams that drive operations, leading to kind of strong balance sheets, healthy margins, and sustainable business models. Lastly, the ability to drive growth. During periods of macro uncertainty, the best companies historically position themselves to thrive when the clouds clear. So they're leading to bigger, faster, stronger companies. Plenty of our companies have said that they will continue to invest in their business because the opportunity is too big to pull back, especially when they're seeing strong returns on those investments. And we'll highlight some of that there. So this page, we step back and we gauge the natural strength of the portfolios in our companies, or the companies in our portfolio. Today, as it stands, every company is a leader in its category. Market leaders provide natural protection and kind of natural protection in tough environments, but they also provide clear opportunities. Every single cycle that if you go back and study history, is the stronger that the company is going in, the leadership position, they have more choices and opportunities to drive future growth. They can pull the price lever, they can not pull the price lever and take market share. And they really can help and assist and control their own future. I highlighted some here, right? So you have Omnicell's #1 medication management. They're 50% of that market. We know Zoom clearly is the #1 video platform by downloads and usage. You have Duolingo, the #1 language learning app, 80% of that market, sales and usage. And the list goes on, right? Now, who's managing these businesses is also just as important. So these companies are led by proven founders. Investing in founders isn't necessarily a requirement by any stretch. It's more of a function of our research process, which is finding companies or management teams that have executed and are aligned, right? Execution and alignment. We've shunned companies with founders because they've gotten to a point where they're not executing anymore, where the business got too big for them, and it requires someone else to step in that knows how to execute, that's proven their execution capabilities. I used the Chipotle one where, there was execution problems, and obviously Brian Niccol from Taco Bell, who's an execution wizard, came in and obviously did really, really well there. But that same kind of concept and mindset, what we know today is many of our companies, if not all, are essentially ran by founders that are fully aligned from an investment perspective, or proven executives that have done this before. All right, so let's jump into the health of these companies, how they're managing the environment, and how they are positioned for the environment, right? So first and foremost, in total, the consolidated portfolio grew this quarter around 27% in revenue. In a world where GDP is around -1% to +1%, so growing 27x the rate of the world. Guidance combined, so what they expect for the remainder of the year is in the high teens to low 20s, again, in what some call a recessionary environment. And again, a lot of this information is in terms of like guidance is super recent. We're talking several weeks, if not days, in some cases. All the companies expect to produce cash flow this year. All of them produce cash flow in one way or another over the last several quarters, or near break even. Another important point is that 8 of the 11 companies discussed today have share buybacks in place. This is critical as the companies will use cash to buy their shares at these levels that we consider to be deflated. So this is ultimately a good thing. It increases our stakes in these businesses as they buy back shares. So let's start with Omnicell. So we've owned Omnicell for quite some time. How are they managing the environment? How are they positioned for the environment? We'll go through the 3 like kind of fundamental pillars, and then provide a quote from the management team. Look, they have a share buyback in place that they executed on. They're the market leader, 50% of their market, large order backlog. They see they sell into the hospital systems, and they're so important to the hospital system as they're driving productivity amongst pharmacists inside a hospital system to automate and manage medications across the system. So they're an investment that drives returns in these hospital systems, and they basically have this extended backlog to fulfill as time moves on. They have pricing power, so they've been raising prices on their products to offset any inflationary headwinds. They're able to do this just given their market dominance. but they also provide, they've improved their tools over time. So there's a value kind of creation that's synergistic with their customers. Operations, so founder-led, Randall Lipps. It's actually a 30-year-old company. It's we've been part of the journey for the last like 5 years. Growing margins, durable balance sheet. They grew 27% sales and expect to grow in the mid 20s. And they have a large product roadmap to continue to expand their platform. Randall Lipps said on 2022 trends, we continue to see robust demand within key areas of advanced services portfolios, which we find reflect our customers' recognition of the need to improve access to and management of complex medications. There's a lot there, a lot of jargon, but more importantly is that they continue to see strong demand. It shows in their numbers. And we think over the next several years, it'll continue to show. This is the platform itself. Again, you can pause and look at it, but again, we've talked about them in the past and we've owned them in the past. So if you're a new investor or a new prospective investor, we'll definitely walk you through. Even if you're an investor and you want to walk through again, more than happy to always do that. We do a pretty good job at doing that. Capri, so they just reported this past week, and again, $1 billion buyback. They own Michael Kors, Versace, Jimmy Choo. The luxury space continues to prove its sustainability during periods of all types. Really, luxury in the recession in 2008 proved to be very, very durable, and that's a good thing. The reality with them is, again, they're a market leader in handbags, but also it's not easy to replicate luxury brands. It's hard to replicate a brand in general, and they're doing so wonderfully. They're growing margins. They have healthy cash flow, $650 million of cash flow. They're returning that to shareholders in the form of buybacks, but also looking to grow their business. So they expect to grow earnings and revenue this year at a record level after finishing a record year. Looking forward in fiscal 2023, we expect to achieve another record year of revenue and earnings per share, said John Idle on the earnings call last week. And then here's kind of the figures. This company trades in the multiples of mid to high single digit cash flow multiple. We think that's far too cheap. This isn't for price targets, but we are more than happy to share the price targets, but it's many multiples from here in our view. Zoom. So, Zoom's done a wonderful job. We didn't invest in Zoom a long time ago, as we were believers that this needed to continue to evolve into multiple products. And until we saw that traction we would stay on the sidelines. Also, valuation in 2020 was outrageous in our view, specifically where the business was then. But there's a lot to like about Zoom today. $1 billion buyback, founder led. We've known and followed Eric Yuan from his days when he was a private company. We are likely to have Kelly Steckelberg, the CFO, on one of our webcasts here in the coming months, and she'll talk about the business. But they are a market leader. One of the best things about them, and from a defensibility standpoint, is they have a reoccurring business model. And well, the other thing here is a travel alternative, and I'll highlight what she said. But operationally, again, $6 billion of cash, more cash on their balance sheet than Apple has on their balance sheet. So this should be seen as kind of like this stable, very strong asset that's out there in the world. 40% cash flow margins, again, reoccurring in nature. The biggest highlight here is 33% of they're seeing 33% growth in enterprise and new product uptakes, and I'll highlight that. But let me give Kelly's quote from the earnings call, literally here in the last week and a half. We have continued to see strength in renewals, as well as additional new customers and expansion into additional products. So we really haven't seen macro concerns. I think we've heard from the other people that they're really focused might be limiting spend. It's focused more around potentially hiring or travel. And of course, Zoom is a great alternative if they're focused on limiting travel. I agree. Here's some of the big wins. So Zoom growth drivers, they won Humana, Avis on Zoom Phone and Zoom Contact Center. Arizona State, we have some Arizona State people that attended the webcast, Intuit, Medtronic. Our whole belief is, they have to continue to extend their product portfolio. Now they have over 3 million users using Zoom Phone. The more usage of new products, the more stickier this product portfolio becomes into a customer. We had a Fundamental Friday podcast that we highlighted. And the big thing is, look, not every customer wants to be a Microsoft customer. As they continue to extend their platform, and as more companies continue to embrace Zoom Phone, the stickier the products become. Enterprise revenue in the middle here, growing 31%. Another stat to throw out there is growing basic customers contributing $100,000 or more in trailing 12-month revenue, growing 46% to almost 3,000 customers. So really constructive there. Nutanix, They had a really strong quarter. The transformation and the thesis continues to progress and is right on track in our perspective. The big takeaway for them is like, here's a market leader from a product perspective and a market share perspective. Their competitor, VMware, it has just actually been acquired, or it's not final or closed, but by Broadcom. Broadcom's known to basically strip down their acquisitions to the bare bone to generate cash flow. We're already hearing, if you just Google Nutanix or VMware Broadcom deal and thoughts around it, the general conclusion is that, this could be an issue for VMware and their customers potentially as they get rid of different products in their portfolio, and a big opportunity for all the competitors around them, including Nutanix. Again, there's many articles out there that are highlighting it, and it makes a lot of obvious sense. They have a reoccurring revenue. So from a defensibility standpoint, they have large growing reoccurring revenue, operationally growing margins, strong cash position, 3.2 year average contract duration. So the customers are signing up for a pretty long time. And again, that provides stability for these businesses. Billing growth and customer count, 22,000 customers, 28% billings growth, and strong renewal strength. Rajiv, the CEO, who has done a wonderful job over the last year, said, against a volatile macro backdrop, we delivered another solid quarter, exceeding all our guided metrics and seeing continued strong performance in our renewable business. So customers that are renewing, those come at a much higher margin. Now, they did experience delays in some of the vendors. Now, I highlight that here because the important thing here is it's not necessarily Nutanix by any stretch. It's really those that provide the hardware to customers. So a customer will say, hey, I want to use Dell or HPE or Pure Storage or Lenovo. And then they'll choose the software to run on it. And that will be maybe VMware or Nutanix. And HPE is seeing record backlogs. So you can see that in the third bullet here. They're seeing record-breaking backlogs. So as backlogs build up, some of the deliveries of these servers are being delayed, whether it's weeks to months to quarters. And ultimately what that means is for Nutanix to start billing the customer, obviously the customer has to get the hardware first to then turn on Nutanix. So some of the start days got moved back slightly, which again, for investors that are looking quarter to quarter or week to week, obviously the delays is never like a perfect thing, but in theory, there's no fundamental issues with the business. And the positive signals highlighted here on this page are all intact. So annual recurring revenue growing 46%. The pipeline grew year over year. Again, we talked to the company right after. They saw improvement in year over year win rates against their largest competitor. So we obviously know who that is. Q3 sales productivity was in line. So their sales reps are selling productively and in line where they thought they would be. They haven't seen any change in the demand for their solutions, kind of despite the macro. And they continue to see solid demand for the cloud platform, which we think is important for the future of this business as well. So many of the positive signals are very much intact. And so as HPE and some others, they're all seeing really strong demand. So that it's like this, it's this positive negative where the demand is so strong, specifically for these companies going more digital, that it's leading to some bottlenecks that are being worked through. And again, we listen to the HP call and things like that. So everything's functioning. Duolingo, the next one, number one language learning app, market leader. They have 80% of downloads in the space. So a large market leader, zero debt, founder-led, low marketing spend. They spend more money on R&D than marketing for a consumer app. We think that's incredible. Part of their business continues to transform to recurring revenue. I'll show that on the next page. 55% bookings growth, 2.9 paid subscribers, plus 60%. They have a new product coming out, Duolingo Math. We talked about that in our monthly bulletin. All elements of our business performed well this quarter and saw accelerating user growth, record quarterly bookings, and strong margins. Duolingo, the next one, number one language learning app, market leader. They have 80% of downloads in the space. So a large market leader, zero debt, founder-led, low marketing spend. They spend more money on R&D than marketing for a consumer app. We think that's incredible. Part of their business continues to transform to recurring revenue. I'll show that on the next page. 55% bookings growth, 2.9 paid subscribers, plus 60%. They have a new product coming out, Duolingo Math. We talked about that in our monthly bulletin. All elements of our business performed well this quarter and saw accelerating user growth, record quarterly bookings, and strong margins. It's pretty obvious. So here's a page showing the percent of users that are paid as a percent of total, 6.8 today. So you can see the progress over the last several years of the amount of paid users as a percent of total users. If you go back to the start of the year, we had Avery Idea Day, And we highlighted and shared basically that they continue to drive premium subscribers, and that's true of what is showing here. We had the CFO on, so go listen to that if you want to listen to more. And then positive free cash flow. Meta, owner of Instagram, WhatsApp, Facebook, and Oculus, market leader. Obviously, they have different segments of revenue. They're scaled. Obviously, they're one of the scaled players out there, which helps them maintain and drive margins. Massive cash balance, again, will allow them to buy back shares. So they have a $29 billion buyback. So it's pretty massive. They're growing users, growing sales. And then the growth engines are Oculus, obviously other parts of kind of call it the metaverse, which we think has utility specifically in the commercial market, and WhatsApp. We talked about the WhatsApp or the Conversations conference that Meta hosted here in the last couple of weeks, where they opened up WhatsApp's API to third-party businesses. So all businesses now can embed WhatsApp into their like website, let's say, and you can communicate on WhatsApp or Messenger or some other things. I actually had an experience with that on Instagram where it was an ad. And if you go on Instagram and you see the click to message ad functions, one, it's a new ad format, but it's a high conversion ad format that we think advertisers will pay quite a bit for, to have a direct communication line with their customer. Again, I had the experience where I was buying something, let's say a book, and it said click to message. I clicked it. It gave me a couple options to message them. I chose WhatsApp. We communicated and eventually bought the product. And it's where the demand came from, and you know that it converted. So there's a clear ROI on that, and a pretty high one, because now they have, in theory, my WhatsApp. But it's good because I chose that experience, right? Zuckerberg said, we made progress this quarter across a number of key company priorities. We remain confident in the long-term opportunities and growth that our product roadmap will unlock. So this just lays out the family monthly active people on the platform, 3.6 billion. On the right is really the future, right? And just the success they're having in Oculus. It's 70% of all the usage on Steam in terms of headsets for VR. So 70%, then clearly the Quest 2 is number one. So they're seeing a lot of their core business is strong, generating a ton of cash. That's allowing them to reinvest that cash into the future of the business. And from a valuation perspective, we think is cheap. And they're doing very well. I mean, the reality is they're not immune to macro uncertainty, but again, they are well positioned to invest throughout uncertainty. Zillow, so we have many pieces on this, but network effects and the market leader, it's hard to replicate what they're doing. We think they are continuing to build, call it the front door of real estate. Their goal is to be the super app of housing. Now, what that ultimately means, we'll see as it comes around. But really, it's a balance of valuation and opportunity as it relates to Zillow. They're really well positioned. This is founder led. They announced a $1 billion buyback. So in total, they have 1.1 billion. They had a 750 million last quarter. So they're buying back shares very aggressively. They have $3.6 billion of cash, asset light today. Last quarter alone, 2.6 billion people visited their sites. They acquired Showing Time, which is for tours. So the next phase, and I'll highlight Rich Barton's quote here, is as we look toward our 2025 targets of 5 billion in consolidated revenue, which is 100% growth here over the next 3 years, and 45% consolidated EBITDA margin, we are focused on delivering innovations across 5 key pillars. Touring. So that's where Showing Time comes in, and they've embedded that now in a bunch of sites, third-party sites. Financing, think mortgages, seller services, enhancing our partner network, and integrating our services. 38% rental user growth this past quarter. So there's a lot of signals that show that this platform continues to grow and expand. And this is just some stats just to highlight why we think obviously they're well positioned. 63% of daily active users amongst essentially call it their main competitors. And that's just 3x the next competitor. So a really well positioned, a lot of cash, and they're positioned to invest while others aren't. They have the cash position and the margin to support it. And from a valuation perspective, again, you know how we feel, and that's that. I lumped Fiverr, Block, and Wix in the same thing. Why? Because there's an important distinction for them. It's really around the return on investment dollars they use for marketing. And let me just go one by one real quick. So Fiverr, the leading freelance marketplace, they have over 4 million buyers on the platform, all founder led. They all have network effects in their own right. They're all market leaders. They're all cash flow positive. They all plan to even further expand their cash flow generation, and they're investing in their business. And we think, again, from a growth perspective, you can see the growth numbers here. but mostly it's the return on investment dollars to continue to invest in their business. We have the quotes on the bottom. And let me go one by one. So I will go with Fiverr first, or I'll go with Block first. And what they're seeing is strong ROI, less than 10 months of return on spend. So if they spend $1, they get that back in less than 10 months. So that's pretty wonderful. Here's Cash App. So Cash App has seen 6x returns over 3 years in terms of $1 spent has turned into $6 over a 3-year period. Square Seller, which is much more mature, is 3x in 4 years. So as long as those metrics and those return on investment dollars continues, these companies are really well positioned to invest and get the blessing, or should get the blessing, of investors that have more than like even a 12-month time horizon to invest to continue to compound this growth. Wix ROI. So again, similar dynamics. They have less than 12-month payback. And here we're showing the cohorts basically like, so on the right, you see the customers that signed up in Q1 2018 they spent $44 million to acquire them, and they've generated 4.5x on that customer base. And you can just see the other user quarters over time. What's interesting about Wix is this is fascinating. So this is basically all the users are brought in by year and how much that user base has spent over time. So I'll start all the way on the bottom. Those users came in, this is 2010. So the users that came in on 2010 are spending more today than they were in 2010. The starting point, they were just literally a website builder, and that has grown over time. So obviously over time, they've expanded their product suite. So customers are starting with a much broader use case. And what you see is over time, these yearly users that they bring in grow and expand the spend on the platform. So Wix grows even without, in theory, bringing on any new customers. Reoccurring revenue on the platform, and very important to these businesses that are on the platform because they're essentially running their websites. Our website is actually runs on Wix. Fiverr, similar characteristics. They even called on the earnings call. They're going to continue to invest. That the opportunity is too big to not invest in, but they still have cash flow, and they will continue to drive margin expansion. Similar thing. So all the way on the right, you can see this is the users they brought in Q1 of 2017. And they spent, let's say $1, they've returned 5 over that period. It's a 5x return on that marketing spend. So they all show this like very similar dynamics. Actually, their return on investment is 4 months in terms of break even on average, which is phenomenal and fairly incredible, actually, to say the least. So that's really it. We're confident in our companies. I think that's the clear takeaway here. Not only based on how they're positioned for normal environments, but specifically during kind of periods where there's a lot of uncertainty. And we think they're positioned financially to take share. They have the margin to do so. Many of them have the cash to buy back shares. Many of them have the ability to buy companies as valuations have come down and invest also in the growth while others kind of potentially pull back spend. So very, very confident in what's going on there. What I did is open it up to Q&A. I will kind of repeat the Q&A here and looked through many of what was out there. And the first question is kind of how do you manage volatility? Our goal isn't really to manage volatility directly, right? So we manage to medium and long-term returns. That's our North Star. There's been plenty of studies around behavioral psychology that show that investors feel 2 times worse to losses than to gains, which is ultimately prevents investors to have the fortitude to hold on long-term, and just as important to add during periods of stress. But that is also why we focus so much of our time and effort with everybody is sharing the details around our companies. And that's what we did today, right? Is they're all healthy and well-positioned no matter the environment. And that's ultimately what keeps us grounded. That confidence is what bridges the hard times to get back into the good times. And that's how we think about kind of that concept. The second is, why do you think some of the companies have gone down in the markets, and will any of those kind of move back? Again, it's a good question. There's many companies out there that have been hit hard. It started maybe kind of a while ago, and it progressed into many of the bigger companies. You saw the Walmarts and Targets get hit hard as well. The market is pretty short-sighted in periods of stress. That's essentially what happens almost every time. And that's just the nature of being in the markets. And it's really understanding what you own and why. And that's ultimately what bridges the gap. In addition, many companies get affiliated with sectors and subsectors. The market is tied together, like I said, during periods of stress, and they throw out the baby with the bathwater, in our view. What that does, again, is opens up the door for the companies that have the firepower to invest in themselves, share buybacks, but also buy targets out there that they believe are good companies trading at low valuations that they can bolt onto their company. But at the core is, a company's valuation should either go down because it was valued way too expensive, and or kind of the fundamentals are deteriorating. And in theory, it could be both. And from our perspective, our watch list is as long as I can remember. It's growing, just given the fact that so many companies have been hit very hard. And again, what happens is the best companies survive and thrive and come out of this much stronger. We've seen that over and over and over again. Last question is really around, or two questions are, how are you taking advantage of the sell-off? So we have a playbook for this. First is, I think you need to understand the issues, ensure there is no permanent loss of capital risk in the portfolio today. We've already done that a long time ago. If you have cash, you obviously put that to work. We've been over the course of the year adding cash that was available in the strategy and fully deployed as I think anyone should be. The next thing you can do is rotate inside of the portfolio. So for example, Electronic Arts, right? That's up for the year. Probably one of the only stocks up this year in general, but you can use that capital and have been using that capital to move into other names. And that makes sense to us. If we look out 3 years and one company has 50% upside in our view, and another is down 40%, and that company that's down 40% now has 150% upside, hypothetically, well, we increase the forward returns of our strategy by making that adjustment. So you don't feel that today. It doesn't feel good, but this has worked in the past. That is the playbook. You can rotate inside the strategy where there's less weakness and more weakness, or trading essentially less weakness for more weakness, where net the fundamentals hasn't necessarily changed. It's more sentiment around it. What are you most excited about? Well, obviously very excited about the portfolio companies. The reality is while the value has gone down, again, like I said, the forward return has gone up for the reasons I just said. We've been able to set up the strategy to sell the less cheaper companies to buy the cheaper ones. Again, this is something that will show over time. And again, I'm excited about the long list of companies that have entered the public markets over the last 2 years. We had a webcast when IPOs were booming, and our take was that, putting valuation aside, the market was being pollinated with more interesting businesses than ever before. And ultimately, what we can do is take advantage of that. Not every company is sustainable in terms of their economics. Not every company had a starting valuation that we felt comfortable with. And only over the last 6 months have we been able to really buy into companies that we think are well-positioned structurally for the future, are transformation stories that are doing really, really well. And you can see that in many of the metrics that we did highlight, were structural and transformation stories of these companies and how they're navigating successfully. So again, that's it. Thanks for attending today. We'll also send out the recording here. Make sure to check out our YouTube page where we publish our recordings. We also have Fundamental Fridays, which is a newer episode or series that we have on our podcast. We don't send it out, to be quite frank. We don't want to bombard everyone with all of our stuff. We had a lot of materials that we always sent out in publications and research and data. We're always doing that. Fundamental Fridays is really around understanding the fundamentals that happen that week, that matter, that drive our decision-making. And it's a short 10, 15-minute excerpt. We bring on guests, CFOs and CEOs, and that's in the pipeline. So again, thanks for coming, and we'll see you next time.